There is a sentence buried inside a Federal Reserve statement that most viewers will never notice. A handful of words tucked between routine language about rates and inflation targets. But to the desks that manage trillions of dollars in reserve assets, that sentence just quietly rewrote the rulebook for one of the oldest metals on Earth. For decades, silver has been treated as the smaller, less trusted cousin of gold, too industrial to be a real safe haven, too historical to be priced like ordinary copper. This week, something shifted, and the people paid to notice these shifts before anyone else are already repositioning. Before we follow that signal to where it leads, it's worth remembering where yesterday's story left off, because the two are connected in ways almost nobody has publicly pieced together yet. Yesterday, we watched gold's rally break apart within hours. A climb toward record highs, collapsing into a wave of selling that erased billions before most investors understood what was happening. Underneath that reversal was a story about rising real yields, a bond market punishing any asset that pays no income, and a crowd of traders who had convinced themselves gold could only move one direction. Then came the twist nobody was prepared for, as Bitcoin began reacting to the exact same macroeconomic pressure that has driven gold for half a century. That reaction traced back to a single mechanism, the real interest rate, the quiet force that decides whether holding a non-yielding asset feels wise or expensive depending on where inflation and bond yields sit. Once that mechanism became visible, the correlation between gold and Bitcoin stopped looking like coincidence and started looking like the early stage of something far larger in how capital defines safety itself. That larger story is exactly where today's chapter begins, because the Federal Reserve just handed silver a new identity, and the implications reach well beyond a single afternoon of price movement. If yesterday's breakdown of gold's psychology changed the way you see this market, make sure you're subscribed, because what happened to silver this week ties directly into that same unfolding pattern. For most of modern financial history, silver has lived a strange double life, half precious metal, half industrial commodity, never fully trusted by central banks the way gold is, yet never fully dismissed by investors who sense it holds more than its price suggests. That dual identity has always made silver difficult to predict, because its price gets pulled in two directions at once, one rooted in monetary fear and the other rooted in factory demand. Solar panels, electronics, and the machinery of the real economy quietly consume enormous amounts of silver every year, treating it purely as an industrial input with no regard for its history as money. But something in the Fed's latest communication suggested policymakers are beginning to think about silver differently, framing it less as a volatile industrial commodity and more as a strategic asset entangled in the same inflation and currency concerns that have always surrounded gold. That distinction might sound subtle to a casual observer, but to institutional money managers, it is precisely the kind of language shift that changes how an asset gets modeled, weighted, and eventually allocated inside portfolios worth trillions. And if you're watching this from Karachi, Manila, Toronto, or anywhere else this story is reaching tonight, drop your city in the comments, because this audience spans more corners of the world than most people realize. To understand why the Fed's words carry this kind of weight, we need to look at the mechanism connecting silver's industrial role to its monetary one, a relationship that has quietly shaped every major silver cycle for the past 50 years. That mechanism, and the way it's about to be tested, is where the next part of this story begins. Silver's dual identity has always been the key to understanding why it moves the way it does, swinging harder than gold in both directions. Because it sits at the intersection of two completely different kinds of demand that rarely move in sync. On one side sits monetary demand, the same fear-driven buying that pushes investors toward gold whenever confidence in currencies wavers, a force rooted in centuries of silver being minted into coins and stored as wealth. On the other side sits industrial demand, a modern and rapidly growing pressure coming from solar panel manufacturing, electric vehicle production, and electronics. These sectors consume silver not because they trust it as a store of value, but because its conductivity makes it irreplaceable in certain technologies. For decades, these two forces mostly canceled each other out, keeping silver locked in a strange, secondary role. It has always been too industrial to be treated purely as a safe haven, yet too historically monetary to be priced like a normal commodity such as copper or aluminum. That tension is precisely what makes the Fed's recent language so significant, because when a central bank starts describing silver in terms usually reserved for gold, it suggests policymakers themselves are beginning to blur that line. Central banks do not choose their words carelessly, especially in official communications that traders, economists, and algorithmic models dissect within minutes of release. When that language leans toward describing an asset as a hedge against currency debasement rather than simply an industrial input, it signals something important about how institutions may begin treating that asset going forward. This is where silver's story starts to intersect with the same forces we traced through gold and Bitcoin, because rising government debt and a bond market demanding higher compensation for risk do not stay contained to a single asset class. If real yields are the mechanism connecting gold and Bitcoin, then silver has quietly been sitting adjacent to that same mechanism all along, just partially obscured by its industrial demand. Once the Fed's own language starts nudging silver toward the monetary side of that equation, institutional models that decide how much of a portfolio should sit in inflation hedges may begin treating silver less like a cyclical commodity and more like a strategic reserve asset. That shift, if it continues, would represent one of the more significant repricings in the metals market in recent memory, because silver has historically traded at a steep discount to gold on a monetary basis. Analysts have long debated that gap without a clear catalyst to close it, and this may be the first real candidate in years. A reminder here for anyone just joining this story mid-episode, because if this kind of deep, connected analysis is useful to you, hitting subscribe means you won't miss the next chapter. And dropping a like helps this kind of long-form breakdown reach more people who are trying to understand these markets seriously. Beyond the Fed's language itself, there is a structural backdrop that makes this moment particularly sensitive, because global silver supply has struggled for years to keep pace with the combined pull of industrial consumption and renewed investment interest. Mine production grows slowly, constrained by the years-long timelines required to bring new deposits online, while demand from solar energy alone has expanded rapidly enough to produce meaningful supply tightness in recent years. When a market already running tight on supply receives a signal that a major central bank is beginning to view it through a more monetary lens, the conditions exist for a very different kind of price behavior than silver has shown in previous cycles. That is not a prediction of where price goes next, because no responsible analyst treats supply tightness as a guarantee of any particular outcome. But it does explain why this Fed language landed with more weight than a casual comment about metals markets normally would. To understand exactly how markets responded in the hours after the signal emerged, and why some traders are already comparing this moment to earlier turning points in gold's own history, we need to look closely at what happened inside the futures and options markets, where the real reaction was unfolding in real time. Within hours of the Fed's language circulating through trading desks, the futures market began showing a pattern that seasoned commodity traders recognized immediately. A quiet but unmistakable shift in positioning that often precedes a larger repricing rather than following one. Open interest in silver contracts started climbing, not in the frantic, headline-driven way retail speculation typically enters a market, but in the slower, more deliberate rhythm associated with institutional desks building positions methodically over multiple sessions. Options activity told a similar story, with increased demand for contracts that would pay off if silver moved meaningfully higher over the coming months. That kind of positioning suggests some professional investors were preparing for a structural shift rather than a short-term bounce. None of this guarantees a particular outcome, and it would be irresponsible to claim otherwise. But this kind of positioning shift is exactly the sort of detail that historically shows up in the early innings of a major reassessment, long before the broader public narrative catches up. What makes this moment especially interesting is how it echoes the earlier stages of gold's own multi-year revaluation, a process that also began quietly, with subtle changes in central bank language and institutional positioning long before it became an obvious, headline-dominating story. Gold's journey from an overlooked, underweighted asset to a centerpiece of reserve strategy did not happen overnight. And it did not happen because of a single announcement. It happened because a series of small signals accumulated until institutions could no longer justify ignoring them. If silver is now entering a similar phase, the implications extend well beyond the metal itself, touching everything from mining equities to the industrial supply chains that depend on silver for solar panels, semiconductors, and the broader electrification of the global economy. A tighter, more monetized silver market could mean higher input costs for industries already navigating complex supply chains. That creates a ripple effect, connecting a central bank's carefully chosen words to decisions being made on factory floors thousands of miles away. At the same time, for investors who have spent years watching gold's ascent while silver lagged behind, this shift raises a question that is impossible to ignore. Is the historic gap between the two metals finally being challenged by forces bigger than any single trading session? That question becomes even more pressing when placed alongside everything we uncovered about gold and Bitcoin. Because if three fundamentally different assets, one ancient, one industrial, and one digital, are all beginning to respond to the same underlying anxieties about currency stability and government debt, the story stops being about individual markets. It starts being about the system underneath all of them. Central banks did not create these pressures overnight, and they will not resolve them overnight either, which means the coming months are likely to bring more of these subtle signals, more carefully worded statements, and more moments where a single sentence quietly reshapes how professional money thinks about risk. For viewers who have followed this series from gold's sudden correction through Bitcoin's unexpected correlation, and now into silver's shifting identity, the pattern connecting all three should be impossible to miss. If this series has helped you see these connections more clearly, take a moment to like this video. Leave a comment with your thoughts on where silver goes from here, and share it with someone who still thinks of silver as just an industrial metal. Its story is still being written. And once again, if you're watching from Lahore, Nairobi, Sao Paulo, or anywhere else this reaches tonight, let us know in the comments, because this global conversation is exactly what keeps these stories connected from one episode to the next. No one can say with certainty exactly how this chapter ends, whether silver's new monetary identity strengthens into something permanent or fades as quickly as it emerged. But one thing is becoming harder to dispute with every passing week. The old boundaries separating gold, silver, and even Bitcoin are blurring in ways that demand closer attention rather than less. The next signal is likely already forming somewhere in the bond market, in a central bank statement, or in the quiet positioning of institutions who move long before headlines catch up. And when it arrives, we'll be here to break it down together, one connected story at a time.